If you would have invested $1,000 into Bitcoin back in 2010, you'd be sitting on over $50 million today. But you never would. You never would have made that. But in this video, I'm going to explain to you why that is, but more importantly, I'm going to show you what it is that you can do about it so you don't miss out the next time. So stay tuned. All right, market disruptors, welcome back to this week's episode where we talk about investing, specifically in market disruption companies, technologies, Bitcoin, cryptocurrencies, etc. Now, I am going to talk about a question today that I get asked all the time, and I've really been getting asked this question a lot more lately. And I think that the reason why is because the cryptocurrency markets are really starting to come back online, kind of like we've been talking about for the last couple of months, like we've been expecting them to, and things are really starting to move. And so people are starting to think about this a lot more. People look back on 2018 and wish they would have sold, they would have taken profits sooner, and they're starting to think about putting these long-term positions in. And so the question that I get asked all the time and getting asked more frequently now is, when should I sell? When do I take profits? How do I know when I should look to get out? How do I know when to get out, take those profits? Do I set that target when I first get in? Am I looking for certain amounts of return, etc.? And so people always want me to help them answer that question, and I do. I love to help answer that question. I'm going to answer that question for you today. However, the answer to that question is not usually what somebody wants to hear, and that is that it depends. So I wish I could give you a black and white answer, but I can't. It's not science. It's not an exact number. It's not science, and it's different for everybody. So everybody has a different number, and so what I'm going to do is I'm going to teach you how to think about that, so I can tell you how to come up with your own number. Now, the reason why I say it is it depends. The reason why I say that it's different for everybody, and the reason why I have a picture of Einstein on the screen up here, is because there's a story about Einstein that I really like, and it's really shaped a lot of the way that I run my investments and really my life. And so Einstein used to be a professor, and every year he had this college class, and he would give the same test. He would give the exact same test every single year. And finally, some of the other college professors came up to Einstein and they said, "Hey, do you know you're giving the same test over and over and over?" He said, "Yeah, I do." And they said, "But why? It's the same questions that you had the last year. The kids are going to know this, and they're going to give the answers to the next kids, and they're going to be cheating. Why would you do that?" And Einstein told them, "Because the answers have changed." You see, so that the answers change. So the questions can be the same, but the answers can be different. And so that's the way that we have to look at our investing. That's the way we have to look at our life. I look at all areas of my life like that. And you have to know when you have to change the way you think about this. So it really comes down to your investing thesis. So that means, why are you investing? Why are you taking a position to that? Now, the reason why the answers may change is that when I enter that position, I think that this is going to happen, right? Based off of the information that I have, I think this is what's going to happen, but things change. Answers change, and so you always have to be ready for that. But that's why it depends. But the first thing that you need to understand before you can figure out when you should sell is understanding what your personal investing thesis is, all right? And again, everybody's different. It's a personal situation. You need to know when you buy, you need to know why. So when you're buying something, you need to know why you're buying something. So hopefully, if you're buying off of somebody's recommendation, they've given you enough information to tell you why they think you should buy it and how long that you should hold it for and how much you expect to make and all of these things, right? So you need to know, when you buy, you need to know why. And so if you're just saying, "Oh, I should buy this investment, this project, this coin, whatever," but you don't know why, then of course you don't know. You don't know how long you should hold. So when you buy, you need to know why. You have to understand what the future is of that. All right? You need to understand what's going to happen with that in the future. Like I said, why did you buy it? What do you expect to happen? Now, if you're a trader, if you're just trading, you don't need to know that. You're looking at the technical analysis and you're saying, okay, I'm buying at this level and I'm expecting to sell it here. So that's the why. The why is to buy it from here and sell it at here, okay? But if I'm an investor, it's a little bit different. And so the investor may look at that and say, I'm buying this because I believe this is going to come true in the future. That could be one example. There could be a bunch of different examples there. One example that I like to give, because everybody seems to understand this, is I'm going to use real estate for an example. It's no secret. I've been a big-time real estate investor for a really long time, developed tens and tens of millions of dollars in real estate. I love it. Real estate is still my exit plan. But I love cryptocurrencies as well. But real estate's an easy example for people to understand. So imagine this, right? So for long-term buying and holding, investing, think about real estate. So imagine if you were at the city council meeting and you heard that, outside of town, I don't know, 10, 20 miles from town, out in the middle of nowhere right now, that they were going to build this new stadium and these hotels and build this whole development out there. And it was going to be, say 10 years, maybe 6, 7 years before they were going to get that built. But you know that this was the plan, it was put in and it was approved. You were at the council meeting and it was approved. Great. Okay, so that's an opportunity as an investor. I can go buy that land out there for next to nothing, for dirt cheap, because nobody wants it right now. But I know that in the future it's going to be worth a lot of money once that development comes into place, right? So I buy that land, okay? So now I know that in 6 or 7 years that stuff will be built and that land will be worth a lot of money. Maybe I have to wait an extra year or two till that demand really goes up. So maybe it's 8, 9, 10 years and it's worth a lot of money. So I do that. But what happens is then I have to wait. I have to wait all that time, right? And what I want to always be asking myself is are the answers changing, right? So is the development still on track? Have the plans been approved? Have they gotten their permits? Are they meeting with banks to get financing? Have they gotten their financing? Are they meeting with contractors? Are they finally breaking ground? As long as all of those things are happening, that continues to make me believe that that future that I bought for, the reason why I bought it, is if all that stuff is still coming true, then I continue to hold. I hold patiently. Now let's say that all that stuff is coming true and 2 years from now, the price of the land drops even more. Am I going to panic? Well, not really. I'm going to look and say, well, is the project still on track? I look and, they've gotten their financing, the construction starting next month. The price of the land went down. I take that as a buying opportunity. I'll buy more, right? Because I know that project is still on track. I know the reason why I bought it is still there. And so if it dips, maybe I'll buy more in the dip, right? And I'll continue to hold. However, here's where it changes. If the answers change, I have to be ready to get out. So for example, I find out that an environmental report came in and there was something wrong with the environmental there, the soil, whatever, and they had to cancel the project. And now it was shut down. Well, if that happens, then I got to get out as quick as I can. I need to get out in front of everybody else because everybody else is going to be trying to sell, dump, and the market's going to go down super fast. So I need to be paying attention. I have to be watching what's going on. It's my investment, right? I'm watching what's going on, and as soon as something more to change, I need to know, and I got to get out. But as long as the project is on track, I stay in. Hopefully that makes sense. Now, this is what I call zero-based thinking. And I took this from Brian Tracy. Brian Tracy is an amazing author. I've read a ton of his books, audio programs, etc. Highly recommend it for anybody that's looking to really elevate their game. Brian Tracy really talks a lot about goal setting, just a lot of things. Anyway, he talks about something he calls zero-based thinking. And he says, quote unquote, knowing what I now know, would I still make the same decision, right? So that's what it comes down to. Knowing what I now know. Now, when I made that decision before, I used the best information I had available at that time. But now new information has come around. So knowing what I now know, would I have still made the same decision? If the answer is no, then you got to get out. You got to get out as quickly as you can. If the answer is yes, then you stay in. So we need to always be practicing zero-based thinking, and not just with our investments. Of course, with our investments is important, but with all areas of our life. If we find ourselves into a situation that's changed, a situation that knowing what I now know, I wouldn't do it again, then you got to get out, right? And so we need to constantly be doing that, but especially in our investments, zero-based thinking. Another example that's maybe a little bit more relevant, maybe definitely more relevant to investors, is Amazon. So Amazon's a great example of this, right? So Amazon went public in 1997. Now, if you guys are old enough to remember the early days of the internet, in 1997, there was hardly really any internet at that time. It was pretty much just email and chat rooms at that time. I know because I was on it. It wasn't really usable. There was just dial-up. It was so slow. It didn't really work. But Amazon went public in 1997 for $1. And they became this online platform, and they were going to change the world with this thing called e-commerce, which wasn't around yet. Nobody had done it yet. And I know it seems weird to look back on that, but that's how it was in 1997. So this was like this big dream, and that the internet is going to change things, and the internet is going to allow us to buy all these things online. And so Amazon started in 1997 for $1. Now, if you bought Amazon in 1997 for $1, why? Why did you buy it, right? By 2000, it had gone all the way up to $80. So from $1 to 80, which was amazing. But by 2001, it was all the way back to $5. So what happened? Well, and what did you do about it? Well, it depends on why you bought it, right? So if you bought it just as a trader, maybe when you bought it at $1, and when it hit $10, you sold it for a 10x return. That was amazing. It was a great trade. Maybe you rode it up all the way up to $80. Maybe you were the smartest guy in the world and you called the market top and you got out at $80, right? Maybe you bought it at a pre-IPO before it went public, and maybe like most IPO guys, you like to get 2 to 10 times return and you flip it, right? And you get out. But if you had bought it with this long-term vision, if you were a true believer in internet technology and you believed, like Amazon did, that the internet was going to change the world the way that the world did commerce, and that you believed that internet sales would be a big thing in the future, that maybe they would overtake retail sales or physical sales, and you believed Amazon would be a major player in that space, then what are you going to do? Then you got to hold, right? Then you have to stay in that trade until what? Until that future becomes reality. So if I bought Amazon for this future reality, I believe that the future would be online sales, and I believe Amazon would be a major player. If I bought it because I believe that to be true, then I have to hold it until either one, that comes true, or two, something changes that makes me think it's not going to come true. Just like that real estate example, right? So I'm holding Amazon until either they are the market leader in internet online buying is the big thing, or something happens that changes my mind. Now, for those of you guys that maybe aren't aware, you can see on this chart it's like a hockey stick. Amazon hit $2,000 a share at the end of last year. So it went from $1, $85, and then all the way up to $2,000. So the true believers, the people that bought Amazon because they believed in that future, have profited big. Now, is that future over? It looks like Amazon's still taking over the world at this point. So there could be a lot of room to run. Now, I'm not saying to buy it, but that's what's happening. So when I say that it depends on all those factors. Did I buy it in an IPO to flip it at 2 to 10 times? Was I trying to trade against it? Or was I buying it because I really believed in that future potential? And that's why I say targets are personal. We all have different reasons why we buy things, right? We all have our own reasons. We all have our own time frames. Maybe, I'm retiring soon, or my kids are going to college soon, so I'm looking over shorter time frames, whereas maybe, you're younger and you're looking out over longer time frames. So we all have these different things, and that's how you have to look at them. So hopefully I'm giving you the framework for that. Now, another one, like I opened up the video with, is Bitcoin, right? So we've heard that if we put $1,000 into Bitcoin in 2010, today it's worth about $50 million. And like I said at the intro, you never would have made that. The reason why is because, as you probably know, the roadmap from Bitcoin from 2010 to today has been very, very bumpy, right? We've crashed 80-90% multiple times. So imagine buying it, for $1 and then it's at $100. Like, how are you not going to sell, right? And then it drops to $5, and then it goes up to $500, and then it goes to $200, and then you're like, shoot, why didn't I sell? If it ever goes back to that all-time high again, I'm out, which it did. It goes back to the all-time, and then it smashes that. So maybe you held out a couple times, and then it crashes 80-90%, and you're like, oh my gosh, why? Why didn't I sell? I should have taken my profits, like what people are saying today about last time, right? And so then maybe you held through that bear market, which is unlikely, but maybe you did. But then it gets back up to the all-time high, and you're like, that's it. I'm taking my profits. I'm done. But then it smashes it again, right? So it's the same thing today. Why did you buy Bitcoin? If you just bought Bitcoin to double your money, great. As soon as it doubles, get out, right? If you bought Bitcoin to make 5x on your money, as soon as you make 5x, get out, great. But if you bought Bitcoin because you believe in a future where Bitcoin is a major currency being used, maybe it's a major unit of account that all currencies are measured against, depends on what you believe Bitcoin to be, your thesis. Now, I talk about that a lot, but it depends on what you believe is the thesis. And so if you believe it's going to be, the base currency of the world, then you got to hold it until that either becomes true or something happens that makes you think that it's not going to come true ever again. Those are the two options that you have. So how do you do that, right? So it's easier said than done, and that's why I said if you would have, even if you could have put $1,000 in back then, if you had a time machine, you never would have held it, because it's not easy. Everything in our human psychology, everything in our human being goes against that. And so how do we do that? So that's the other part I want to tell you. I wanted to first highlight what happens, but now I want to tell you how to do that. So a couple things. One is understanding what that thesis is, right? Understanding why you buy. Two, watching the signs to make sure it's either continuing to come true or it's no longer coming true, right? So we have to continue to watch that. But then, we always want to think about risk and reward. So we understand that all investing, all trading, really everything in life is always about risk and reward, right? In order to get something, we have to give something. And so if I'm going to invest, there's a potential upside, but there's also a potential I could lose my money, right? So understand the risk and reward and making sure those are balanced properly for you. Another thing that you can do, something that I do quite often, is I like to take profits to reduce my risk. So let's say, for example, and I do this quite often, is I'll get into like a pre-IPO deal. And I believe that this company, here's a real one, for example. I bought into this company called Aqua Metals, and they recycle lead batteries. And I got in on a pre-IPO. And I think we got in for like $4. And I knew that they had all these contracts, and they looked like they were going to be the leader in this new market. And I know I want to hold that, and I want to own it. However, what I want to do is I want to take my money, I want to get my risk off. So what I did is I invested, I knew what I want to hold for the long term, but I invested more than that today. And then I got in pre-IPO, so after about 6-8 months, it had gone up enough where I was able to sell like 40% of my position, take 100% of my money off the table with a little bit of profit, and then I can keep what I wanted for long term on. And now I've already taken all my risk off, plus I've taken my profit off. And now I've kept that, what I already wanted for the long term, and that's still there. So that's one way to do that. Take profits early, take your risk off. Now, I'm not saying take profits early so you don't take the upside. What I'm saying is take some of the risk off, but still stay in for the upside, right? Another way that we do this, how we stay in, is through asset allocation and diversification. So we want to make sure that we're not putting all our money into one asset, because when these things go up and down, we're going to be so stressed out, we'll never be able to handle that. So we want to make sure we're allocated across different asset classes. So even if one asset class is going down, another one's going up, and our portfolio is balancing itself out. And then the last thing that we really want to do is through small position sizes. So when you're investing into early stage technology like Amazon, for example, like most venture capitalists, like getting Uber deals or something like that, or like this battery deal I told you about at the IPO, or Bitcoin, cryptocurrencies, etc. They're very risky, they're very volatile, but they have asymmetric returns, which means they have way more upside than downside. And what that means is that we don't have to put a lot of money in to make a lot of money back. So we can put little bits of money in and make huge returns. We've seen time after time after time where $500 has turned into $20,000, $30,000, right? So you don't need a lot of money. So when you put just a little bit of money in, $500, right? You put $500 in, if it drops to $300 or $200, you're not really sweating, right? You're not losing sleep over it. And so you use small position sizes. That's what allows you to stay in it for the long run. You can just put that $500 in there and forget about it, but maybe that $500 could turn into $100,000, $50,000 in the future, right? So those are the tips. That's what I recommend. That's what I do. Understand why you buy it. Understand what your time frames are. Understand the why. Continue to monitor the progress and practice zero-based thinking. So if something changes, if the answer changed, be ready to get out. And then use asset allocation, diversification, and position sizing to limit your risk, all right? And if you want to do a little bit more advanced strategy, like I said before, you can put in a little bit more than what you want to hold for the long term, take some profits out, get your risk off the table, and then continue to hold. So that's it. That's the key to success with investing, especially in asymmetric new technology investments. Hopefully that makes sense to you, and good luck to you. If you've liked this video, make sure to give me some thumbs up on this. I really like your feedback. And if you don't like it, go ahead and give me thumbs down. Let me know why. Leave me notes in the comments. I love to answer all the comments. You know that. I love to have conversations, discussions with everybody there. So leave me comments. And that's it. To your success. I'm out.